Hello, my name is Danil Sinkin. My student number is 8085766. This is FIN322. I am answering question 1 and question 3. I'm going to explain what I did, why I did it, and what I learned in this Viva. So, starting question 1, I did 2 days worth of day trading, and I did it on MetaTrader 5 demo account because that's what I traded on before the course. That's kind of what my friend got me into. And well, my goal was not to just make trades out of the blue, but to justify them through following the real-time events that are and news that are coming out, which will obviously impact strengthening of one part and weakening of the other part, and it will be impacted on top of that by the spread, liquidity, and slippage, mainly slippage, because if everything's too volatile, then transaction is not gonna go through. It's gonna go through, but not at the price you wanted. So I'm gonna talk about how I mitigated that. But the instruments, the assets I picked were pairs between metals and USD, pairs between crypto and USD, and different currencies that I found to be volatile. Why didn't I pick the real estate index? Why didn't I pick S&P 500? Why didn't I pick just, let's say, Tesla stock or something like that? Why didn't I pick just gold in general? Because it's not volatile enough to day trade at the moment. There's very little money to be made. Sure, you can leverage yourself out of your mind, but I only don't want to do it too much. I already leveraged myself here, as you will see in my report, but I don't want to do it overly, obviously. So I used some technical analysis. I had to judge whether or not it will rebound or it will continue, aka is it gonna follow a contrarian? Is there momentum or not? Or is it going to back up? What I used for that, obviously, I used the RSI, which is a metric which is available on my website. And it confirms momentum and shows me, does the market overbuying? Is it overselling? Is the trend kind of going to continue or not? And that's how I mostly judged my technical analysis. For the risk control, it was quite simple. It was stop loss and take profit, which is available on the website. I did the 3-to-1 reward to risk ratio because I couldn't be hopeful that I'm gonna win majority of my trades. I'm way too new to this. So I was hoping that I'm going to win some and they will compensate for the majority of lost trades. And that's why it made sense. And I didn't risk more than 10% of my total capital per trade, obviously not to lose everything at once. And I did not do any manual exits because I didn't want to fall into emotional trading. So I was just adjusting those so that it would either liquidate me at the stop loss or take me out at the profit take. That's what I did. I did 9 trades total. 44 of them were successful, so took profit. 33 were stop loss triggered. One was broke even and one was inconclusive, aka I'm just gonna count them as also failed pretty much because of the costs that come out of it. If I'm breaking even, I'm still kind of losing money. But even then, because I got lucky on those trades, I actually made money, and as you can see, I went from 1,000 to 1.7 thousand. That was nice. Now, moving to question 3 for the executive summary. No, not executive summary, my bad. We're talking about the passive equity portfolio management, and we're looking what is the equity vehicle I'm going to be using. Obviously, the question suggested me to use ETF, and that's what I did. But I needed to define one, and I had to look at 5 strategies in order to select one that would make sense. And the ones I picked were to buy in and hold for long. Then to find the second one was to find an ETF which would benchmark an index. In this case, it was the World Paris Alignment Climate Index. Then I had to either pick one that would completely adhere to the weight structure of the index, the ETF, or whether or not it's going to use a sampled approach. I ended up using the full adherence because that's just much easier, even though it has greater costs. It's much easier to forecast and therefore not end up surprised if it becomes too volatile. And lastly, I used what's called the futures overlay, which is just a strategy to quickly move money in and out of your ETF. And maximize exposure, not wait on when the stocks are available, because it needs to match my buy order with a sell order from someone else, which is not instant, and these stocks that are in here are quite obscure. So that's why it's useful. My performance testing in this regard, I took 1 year and since inception of the ETF, and I calculated the cumulative return, the max drawdown, the compound annual growth rate. So cumulative returns were pretty good. You can see it in my report. But at the same time, max drawdown was quite noticeable, meaning that yes, you will make money as an investor, but if you're an emotional trader, if you're going to panic sell, then you might as well not do any of this. So this ETF would be recommended as an equity vehicle, an investment tool to a trader which has his emotions under control. And since it's accumulated, that's the only ones I looked at. That means it reinvests all the dividends back in, so therefore it's as passive as possible. You don't need to touch it for long. And here you go. That's kind of what I wrote. In more detail, you can see in my report.